Hello, welcome to this special show. We have with us the Chief Economic Adviser Arvind Subramanian. It's always a pleasure to have you with us on the program, especially on a day when you've just tabled the next version, or the version 2 of the economic survey, the mid-year version, if you like. And it has a lot of very interesting takes on the state of the economy, which I'm about to come to. First of all, I guess a lot of people are wondering, and we are over the course of the next 45 minutes going to take you through exactly a lot of the graphics that you put out, a lot of the details to try and understand what the state of the economy would be. Perhaps I could start off by just trying to summarize what caught our eye as perhaps the big headlines from all of this, and then I'll ask you whether you agree with them. So here to our mind were some of the major headlines from what the economic survey seems to be saying. First of all, there seems to be some concern the economy is looking sluggish. Growth seems to be an area of some concern. There's very clearly a risk to growth on the downside. In fact, I think that's specifically the language that's used. There's a downside risk to what those growth numbers are going to be. Inflation, though, price rise, in other words, low, very low. And that's, well, good and bad. Price rise being low is normally a good thing. But if it tips over into deflation, then that's, I guess, a big concern. A very clear indication from the Chief Economic Advisor, from the economic survey, that we need interest rate cuts, and we need big interest rate cuts. And I'm going to ask Mr. Subramanian just about that in a couple of minutes. Also, a statement that there seems to be some financial market exuberance that may not entirely be backed by the real economy. So those, some of the big headlines from the state of the economy, and there are some things in there which perhaps you should be worrying about just a touch. But there's other stuff there as well. For example, there's some good news, and the good news is macroeconomic stability. The economic survey talks about the fact that there seems to be a certain amount of macroeconomic stability and the anticipation of macroeconomic stability, which is sometimes equally important. Reforms on track, that's something else that is being spoken about. And one of the possible impacts of GST and demonetization, many new taxpayers. So that, at least to our mind, seems to be some of the big headlines that are emerging. Does that roughly sum up the state of the economy from what you were saying?
Yeah, it's well put. Maybe a way of rephrasing it would be to say that, the medium term looks good because structural reforms are on course. We had, for example, the GST, the decision to privatize Air India, and of course very important steps taken to address what we call the twin balance sheet challenge, the whole NPA situation. And this, what I call, a regime shift on macroeconomic stability. Yeah? So that's, I think, all those are things that augur well for the medium term. But the worries are for the near term, what you mentioned, the growth, and today's IIP number also came out.
So today's IIP number, it's 0.1, down from 1.7. 1.7 was bad. Yeah. 0.1 means we're not that far away from tipping over. Some people are saying, are we going to head for deflation right now? 0.1 is a pretty bad number for industry to be growing at.
See, firstly, I think no one number should be taken as indicative of the entire economy. But as we say in the survey, I think what you see is that a series of indicators, credit, IIP, gross value added, investment, they've all been decelerating since about the first or the second quarter of last year. And so it's kind of a trend deceleration, which doesn't seem to be reversing itself. And that's why I think the near term, and the way we put it is that there are lots of deflationary impulses weighing on the economy for the short run, which you captured in your first slide. And I think that's what we need to think about carefully.
If I could just explain that for a layperson who's just sort of switching on and saying, well, are we in a good shape, are we in a bad shape? Would it be correct to sum it up like this, that the economy seems to be slowing down, industry certainly is slowing down, it doesn't have quite that same passion as it once did. And here, for example, is that first set of graphics that we might want to show. This is the sluggishness, and you can see there is that slowdown. Credit growth is down, manufacturing growth down. If you extend it to today's numbers, it's even further. You're almost at that 0% mark. So it is slowing down, value added falling, all of this is down. Economy slow, sluggish, price rise also then is, which I want to come to, is also down. People think that's good. What can be done to turn this around? Why is the economy so slow?
See, I think that what is happening is that a series of, I think, factors are weighing on the economy. I think See, firstly, of course, the big issue is, our NPAs are what we call the twin balance sheet challenge. Firms are not borrowing because they have too much debt. Banks are not supplying as much credit as they should because they also have a lot of NPAs. So I think that's a big growth challenge, and it's been there for some time. And just to put it in context,
and I'm going to come back to that a little later in the program, because you spoke about solutions to the NPA issue in the first economic survey. And I know you felt that a lot of it could be taken out, put into a taken aside, put into a TARP, put into the TARP type thing,
bad bank
or something like that. If that's still the solution, I'll return to that. But the reason I'm coming back to growth again is because at a time when India is supposed to be the fastest growing economy, those numbers are not looking good, and that obviously has a major impact on what would arguably be the single biggest concern for the government today, which is a lack of jobs.
Yeah, I think that let's keep the two separate. I do think that growth is slowing down. And I think, but the number is still, according to the official numbers, is still, reasonable. It's whatever the last number for the fourth quarter came in at about 5.5–6%, but it is slowing down. So I think, in level terms, we're not doing too badly, but I think the trend is what is worrying, and I think we need to act on it. See, a few factors that are weighing on the economy, which I think we should be aware of. One is that, the farm loan waiver, for example, right? I don't want to get into the rights and wrongs of farm loan waivers, because I think, for example, the governor of the RBI said some very thoughtful things about what it means for credit culture and so on. But what we wanted to highlight here is that the farm loan waiver, contrary to what people think, is actually another it's going to reduce demand in the economy, because of the funny way in which it works.
Theoretically, you think that a farm loan waiver means that farmers have more money in their hands, and so they will spend more, and so actually it's good.
But it's counterintuitive, because what happens is that the government, in order to meet the farm loan waiver, has to cut other expenditures, because we have this ceiling on the deficits that states can run. And as long as the centre has said, as the finance minister has said, that we will not allow state deficits to go beyond what is mandated, then states have to cut other expenditure.
So if you're going to do a farm loan waiver, you can't build roads, you can't do other things, you can't build infrastructure, and as a result of that,
economy slows. And in fact, this is not hypothetical, Vikram, it's exactly what's happening in Uttar Pradesh. When Uttar Pradesh presented its budget, about 2 weeks ago, capital expenditure was slashed by about 13% to make a room for the waiver.
So it's almost the opposite of what the central budget was trying to do, which was that let's spend a lot on infrastructure.
Exactly, yeah.
I'm just going to come to the second. I'm going to, as I said, all those various highlights I'm going to go to in some detail. So let's just come to the second part of it, which is inflation.
Yeah.
And if you look at the inflation numbers that are out there, it's actually a real drop. We're not that far away from deflation. I mean, look at that. Look at the headline CPI number. It's all the way down. It's virtually at zero, well below target. So normally you would say this is good. Price rise, if you ask anybody what politically is the most desirable thing, we shouldn't have inflation. Now, almost there. Inflation is low. What do you think is underlying this? And would you be happy about this, or would you be saying this is not always a good sign because it's hinting at deflation?
No, I think we're nowhere close to, on the price thing, nowhere close to, worrying like advanced economies did, for the last 7–8 years. This is unambiguously good news. I think, as I say, it's because of good actions taken by the government, by the RBI, and by technology. Basically, the oil market has changed dramatically. That's put oil prices down. That's helped us. I think domestically, agriculture also has become less volatile, less inflationary pressures, apart from a few commodities. So a combination of these things has brought inflation down. This means more purchasing power in the hands of consumers. So it's unambiguously good. The question is, how should we respond to that? I think that's the big issue going forward. Also, I think we should keep in mind that some people think, with some justification, that this will naturally turn up because some of the factors that are bringing it down are temporary. That could well be possible. But I think we argue that even if it comes back, it will settle down at a level well below what we've seen in the past. And that's what we say in this, we mean in the survey when we say there's a structural change in the inflationary process towards lower inflation.
Hang on. Again, if I can try and decipher what that means. Are you saying we should start building in a different set of inflation expectations? In India, we expect that prices are going to rise, let's say 6%, 7%, 8%. That's what the common expectation is. That's the level at which prices will rise. You now seem to be saying we should change those expectations and get used to a lower level of price rise.
I think actually, Vikram, you made actually a really brilliant point, because that's exactly what it means. You know, when the inflation process comes down, the way it feeds going forward is exactly that people start building that into expectations. So one of the things that people don't realize about inflation is that we not just want reasonably low inflation, we also want very reasonably low inflation expectations, because that's what determines prices going forward. If you expect inflation to be down, then people say, well, I don't need as much wage increase as I used to, and that reinforces the low inflation cycle. So I think
if you're expecting 8% price rises, you'll say my salary should go up by at least 9%.
Exactly.
If you think prices are going to go up by 3 or 4%, then it's okay, I'm getting a 4% or 5% price rise.
And just to put numbers on what you said, I think instead of expecting now 5 and 6% that we used to, I think we should think about expecting 3 and 4% going forward.
3 and 4% going forward, and you think this is going to be true for like a longish period? It's not just because there's a short-term temporary issue, oil prices being sluggish, food, things like that. You're saying over a period of time, 5 years, 10 years, 15 years, prices will not go up more than 3 or 4%.
See, Vikram, in this business, one can never look forward 5, 10 years. But I think over the next few years, we can, I think, comfortably expect much lower levels of inflation than we've had in the past, because fundamental structural shifts have taken place. Oil price or the oil market is a very different beast now than it used to be. Domestic agriculture,
and if electric cars come, oil prices may never go up.
Exactly, renewables, electric cars, all of that is happening. And as you say, once we start building that into expectations, I think we can sustain lower inflation going forward. That's, I think,
okay. If you look at the two things that we have just shown, that you're having growth looking slightly sluggish, you're concerned about growth, and you've got low inflation. There's one obvious message that comes out of this, and let's put that up on the screen, because the obvious hint that would be coming presumably from you is, RBI, why aren't you cutting interest rates and cutting them much further? They cut them by 0.25 points right now. But theoretically, if let's just put that up, that's what real interest rates are looking like. This I'm just taking from the graphics that you were showing earlier in the day. Real interest rates are actually shooting up. They're now at about the 4% rate. That's probably the highest level of real interest rates that we've been seeing very high. And I'm going to explain why this becomes important. It's also important because if you compare interest rates now in India, and this is again something you were talking about, compare interest rates now in India, real interest rates in India with many of our competitors, that's where India is at. If India is at 4.6%, Thailand is 2.2%, China is 2.1%, Singapore is 0.7%. How is Indian industry going to be considered competitive? I'm sure that's the question that you're asking.
Yeah, see, I think, or different ways. So one, of course, is that real interest rates have been rising. That means the cost of borrowing has been going up substantially. Because remember, the cost of borrowing is determined not just by how much you pay, but what you get for the product that you sell. That's why you look at real interest rates. The second thing implicit in that second graphic that you showed is that if our real interest rates are higher than in other countries, people invest in rupees. That takes the exchange rate, makes it stronger, and makes our economy less competitive. So in a sense, you get a kind of double whammy, right? The cost of borrowing is more, and the exchange rate is more stronger, and so the economy suffers on both those.
Triple whammy in a sense, because if interest rates are high, it also makes that other problem much worse of about your high NPAs. Exactly. People have borrowed a lot of money.
Yeah.
They're sitting on debts. They're paying very high interest on that. If actually you were to have interest rates coming down, potentially makes it easier.
Exactly, and that's actually a third very good point, that debt resolution, etc., is easier if interest rates are lower than higher. So all these things factor into an outlook.
So if you were to, I mean, look, I know I'm pushing you a little bit on this, but if you were to be talking to the RBI governor, and he's done a 0.25% rate cut, would you be tempted to say, no, come on, get on with it. You don't need a 0.25% cut. You need to cut it by 1%. You need to cut it by 1.5%. That much. I mean, is the RBI also, does the RBI need to change its own inflationary expectations? If there's a new paradigm out here, maybe they haven't got it.
Well, I think that's something that you should ask them. But I think, I think there's another technical point to keep in mind, right? You see, when we think about what interest rates should be, there's a kind of there's a rule, kind of, it's a rough rule of thumb, which says that if the economy is purring along nicely, right, growth is where it should be, inflation is where you want it to be, then the interest rate should be what's called a neutral interest rate. Yeah? And the RBI itself has said that neutral interest rate is about 1.25 to, in real terms, 1.75%. You back that out, that basically means that by the RBI's own estimates, that neutral rate should be somewhere between 5.25 and 5.75%. Okay, so that's, and we're at 6 today.
Which is way below what we are right now.
But I think there's a second argument which I think is important to make as a technical point, is that that is where you should be if the economy is where you want it to be. But if the economy is weaker than that and inflation is lower, you actually want your interest rates to be lower than that, because the economy needs that more extra injection.
So hang on. Let me again. I'm going to come up with another graphic that I saw. So let's just look at the movement of interest rates. This is what the interest rates have been going along at for a period of time. That's the rate at which repo rate basically means that's the rate. Now you're saying if the neutral rate is something like 5.25%, you're saying that you should actually shoot all the way down, go down to 4, go down to 4.5, something like that. So there's a room for a massive cut in interest rates, is what you're saying.
I think both in terms of the scope and the need for the economy. I think that one view would be that there is scope, but I think there are other views that others might hold, which I think we need to discuss. But I think that's where the debate should be in India now. That is there more room? How much more room? And how? Because I think that the counter argument is there are two counter arguments to this, I think, which we should take very seriously. One is that don't rely completely on monetary policy for growth. There are other levers as well. And I think my response to that would be absolutely, we should do this and we should do other things as well. The second, I think, counter to that, which has been made by some very thoughtful people, eminent people, is to say that, look, even if you cut the policy rate, it doesn't get transmitted into the rest of the economy. And one of the things we show in the survey is that that's true for some things, but it's not true for a lot of the new lending that takes place. And in fact, these cuts do get translated, and therefore all borrowers, including small and medium enterprises, will benefit by that. So I think, but this is the kind of debate we ought to be having, I think.
Okay, so what would be your own personal preference? Where would you like to see the interest rate? If you had to choose, I mean, you're not the decision maker in this.
Yeah, exactly. I'm not the decision maker.
You're not the decision, but I'm sure you have a preference. So if you would like to see interest rates, where would you like to see them?
My technical assessment, based on the analysis that we've done, it's kind of my view, is that there is substantial scope for easing. Yeah.
Okay, below 5%, in other words.
I mean, numbers, whatever the numbers we put out, 25 to 75, plus something more for the cycle. So fair amount.
Okay, so fair amount of cutting. I'm going to start taking some questions also. By the way, if you have questions on everything that we're discussing, you can just keep sending them to us, tweet them, and I will take them. One of the interesting things that you said, and perhaps it's a result of all of this, the economy not looking that good. You're now starting to say you have, however, seen a massive bull market, which is some people have been scratching their heads about a bit and saying, why has there been such a wild bull market? Now, the last 4 or 5 days, in fact, if you can have today's Sensex figures, which will flash up for you. Markets fell again today, and they've been falling for the last 3 or 4 days. You did refer today to what you called exuberance, financial markets exuberance. I'm sort of quoting from your presentation. Financial markets exuberance decoupled from real economy. Oh, there you go. They actually have exactly what you said. Financial markets exuberance decoupled from real economy, related to international excess liquidity. Is that a polite way of saying what was once said famously in America, that there's irrational exuberance in the stock markets right now, and you can't understand why the markets have been as buoyant as they have? And we will now flash up what happened today, because the markets have been down.
I think, Vikram, what is really interesting is that what you just showed, the graphic, is true across the world. that.
And it's a liquidity-driven rally. There's a Trump trade, the other factors.
All of that. So in all emerging market countries, there's been this exuberance because of excess liquidity. It's not unique. I take away two lessons from that. One is that given that these are being driven by liquidity things, we should not read too much into what this signals about the economy.
Up or down, those are today's numbers. Sensex fell 300 points. I think I don't know whether they were anticipating your economic survey or not.
But the second point most speaks to that. See, again, here the evidence of history is very clear that when you get these very high valuations out of line with historical averages and fundamentals, this is what Robert Shiller, the famous economist, he made a kind of living out of this, showing this, that then you do get what we call mean reversion, which is a very jargonized way of saying that these valuations do adjust over time to more realistic levels. And but
some
timing
would say that the valuation, if growth returns and those valuations aren't crazy, over the last 10 years, it's not the Indian economy has outperformed. But the crucial point is, if growth returns and if growth is in doubt, then there are reasons to be concerned.
I think two things. One, when global liquidity turns, I think you will again see something affecting all markets. Second, then there's a kind of country-specific phenomenon. If, for example, you see, it depends not just on your outlook for growth, but also on your outlook for profits. Because remember, share prices are related to profit growth. So not only do you need to get high, rapid growth going forward, that should also translate into rapid profit growth. So if either of those is not met, then there will be some readjustment of asset price valuations.
All right. You know the questions that I'm itching to get to, which are demonetization and its impact, and GST and its impact, and I'm going to come to both of those in just a couple of minutes. Demonetization in particular, because many of us are still scratching our head to try and figure out what the impact of demonetization was. But just want to touch on one of the other things that you mentioned in your survey. You were talking about structural reforms and the fact that that process is on. GST itself being one of those. But there were other factors also that the survey talks about. You're talking about many new registrants who've come up after GST, in principle decision to privatize Air India, rationalization of energy subsidies and the possibility of doing more of that, actions to address the twin balance sheet channel. So these are just some of the things that you spoke about.
Yeah.
I just want to get into GST a little bit. How is that panning out? A period has passed. Maybe you haven't seen or heard of the disruptions that some were fearing, but at least at some level there's still some confusion. Not everyone has completely been able to figure it out, which is perhaps only to be expected.
Yeah, I'll be honest with you. I think this is the implementation has surprised me on the upside. I think that yes, there have been frictions and disruptions, Surat, textiles, and so on, but in terms of movement of goods across borders, border posts have been eliminated, and I think that some of it was unavoidable. In fact, I would go further and argue that if you didn't see the disruptions and the frictions, then maybe the reforms are not actually kicking in. So I think that is happening. It's less than that. There's going to be some more, but I think on the other side, some of the new important things that have happened, this 13.5 lakh new registrants, I mean, it's an astonishingly high number if you think about it, because under the old system there used to be about 80 to 81 lakh registrants, and about 71 of those migrated. Some of it all didn't migrate because they were below the threshold. But now you're seeing actually, at a very rapid pace new registrants, which basically means the objective of getting more people into the formal economy is working. And in fact, something that we did, which we didn't put in the survey because I think we need to do more work on this, is that we looked at what the potential increase in the tax base could be from this, and it's quite substantial. So I think
is it entirely because of GST, or is it also partly because of demonetization? I mean, and because, let's face it, and this is one of the things that the government's probably got very correct, with so much emphasis, you have to do PAN for everything, Aadhaar for everything has to be accounted for. Some people worry about privacy and other things, but there's certainly an impression that you can't hide anymore.
Exactly.
You can't walk around with stashes of cash and go into a some luxury mall and buy some stuff and hope that you'll get away with it,
right?
Which may be bringing a lot more people into the tax net.
Yeah. See,
are you starting to see that happening?
In fact, I think this is a good moment to actually talk about. See, what we saw, because your question is a good one. How much is GST? How much is demonetization? And the way to link the two is to see that There, the 13.5 lakh you saw was for the GST. But in other evidence we've provided on the demonetization, on the income tax side, we see something like 5 or more lakh new individual income taxpayers after demonetization. So in a sense, both are going in parallel, and I think both are.
Can I just bring that graphic up? I'm going to take a graphic from your presentation. I'm going to ask you to explain it, because many of us couldn't quite figure out what you were trying to get at. Let's just bring that graphic up. New taxpayers. Just explain this graphic to us. What exactly does this say?
I think there's been a lot of confusion, right? I think people looked at, when the headline numbers first came out, people looked at the numbers saying, I think it was something like 81 or something new taxpayers, in 16-17, and then people thought we were saying that that's the demonetization effect. So we've tried to be a little bit more careful here in trying to identify how many more new taxpayers happened after demonetization. So what we did was...
So the growth rate, which was 25%, has now gone up to 45%, which is a big jump.
Yeah.
And if you look at the numbers, that's saying about 5 lakh possible new taxpayers are thanks to demonetization.
Yeah.
Add that to 13 lakhs because of GST, 18 lakh.
Yeah, but these are different. One is on the indirect tax side, this is on the income tax side.
I get it. But I'm saying potentially a lot more people coming into the tax net.
Exactly.
And that growth in returned income, as you call it, that means that 54% increase you're seeing in income?
No. See, now here's where one has to be careful, right? The good news is, from what our analysis shows, that after demonetization, there are all these additional taxpayers. But what is really interesting is, if you look at what the average income reported by those new guys are, it's very close to the threshold. So essentially what we've seen is more taxpayers, but not necessarily more taxable income, because it seems like these new taxpayers are reporting income at which they may not have to pay a lot of taxes.
But they're coming into the net.
That's very good news.
So they are coming into the net, so they can be monitored, and potentially
exactly.
in the future you can figure out what's going to happen to them.